Thank you all for joining us. I'm really excited about this event because BDC is a crown corporation and our mandate is to have an impact and provide value-added services. We decided that we'd focus the second BDC Tech Talks around this topic and answer your questions revolving around SaaS metrics, financing options, investor criteria, and so on. I also wanted to take the opportunity to bring some experts, such as Wilson here, who had their own SaaS companies, sold them successfully, and now want to share their experiences and best practices with you. We do have a lot of content, as you can see, to get through today, so I will get started. And I would like to invite Wilson Lee and Craig Rennick here from consultants with Bright Iron. And as I mentioned, they previously had their own SaaS company, sold it. So I will leave it to him to speak about SaaS metrics and what it means to your business. Thank you.
So just a real quick background. So as Demystify mentioned, both Craig and I actually worked together in two different SaaS startups, and so we understand the trials and tribulations and the pain that everyone goes through trying to build this business model. We actually were one of the guys that built it when it wasn't even called SaaS, so we're dating ourselves a little bit. So we called it an application service provider, but it was the same concept, right? Data in the cloud, application in the cloud, people using browsers to access it, right? And so it was a company called Flow Network in the email marketing space, and we ended up building it to filing to take it for an IPO and raising over $33 million of capital for this company, growing to 300 people. And then we ended up getting acquired by a company called DoubleClick, who we just kept beating in the market, and they decided to take us out, and it was a good outcome for everybody. And then the second time that Craig and I worked together was in a company called Proofpoint, Fortiva, that got acquired by a company called Proofpoint in the Valley. And again, this was a cloud-based company, and this one was a slightly different one in that it had a much different kind of characteristics from a lifetime value perspective and whatnot. But anyhow, so we're here to try and share our ideas and kind of our learnings with you. And we've done it through kind of building a boutique advisory firm called Bright Iron, which is looking to bring together the best the minds of the people who have been in operational environments and have built and scaled companies, both from a financial perspective and from a sales leadership perspective. So I'll turn it over to Craig and let him introduce himself briefly, and then we'll just get into the content.
So hi everyone, Craig Rennick. Wilson gave a good overview. I've been with 4 tech startups and I've consulted for as many. And I think sort of a couple of the greatest things I did or experienced was in one of those companies, got to a MRR, which we'll talk about, that's monthly recurrent revenue, of $3 million a month. And I can tell you, when you get to $3 million a month in monthly revenue, your CFO lets you have a big party.
That's right. Lots of big parties, yeah.
And the other is, was a slower ramp. I left when it was $500,000 a month, but it's now about $8 million a month. So I'm gone, but the baby still cooks. It still continues to roll on, provided there's low churn. So this business model is incredibly awesome. It's great to be part of it, but it takes a period of time. We're going to talk about those metrics and what you should be looking for as you build your SaaS company.
Perfect. So digging right into it, so really quickly, what we want to talk about is just kind of the core SaaS business model. A lot of you will know it, but just kind of to do a level set, the unit economics that you should be looking at, some sales metrics. Churn is very important in the SaaS business model, obviously, and so those are some of the key topics we're going to cover. We're going to try and make it at a fairly high level, and then there'll be a Q&A session at the end, so we'll open it up if you guys want to drill down into a little bit more detail. But for purposes of the presentation, we'll try and keep it pretty high level given the time constraints that we have.
Okay, just a quick overview of the glossary. LTV, lifetime value. These are all the critical metrics. The CAC, or cost of acquiring a customer, CAC. Recurrent revenue, monthly recurrent revenue, MRR. ACV is your annual customer value. And the dreaded churn, which is customers lost.
Okay, so this first slide here is really just to talk about the core of kind of the SaaS business model. And I wish some of this stuff was in existence when I was involved with my first SaaS company, because I didn't realize all this stuff, right? So the science has really evolved a lot more now. And what this is picturing here, what this is painting, is that it's a single customer use case. The customer has it costs you $6,000 to acquire this customer through sales and marketing as your customer acquisition costs. And you're billing this customer $500 a month, right? So that's kind of the assumptions on this thing. And what it's showing is that you know, when you spend that $6,000 to get the customer, you're $6,000 in the hole. So you've laid out all this money to get this customer, and you're not getting any cash for it because you're billing monthly, right? So it takes you, and you'll see here, you're in a negative position until the first month where they bill, and you get your first 500 of billings, then another, and slowly you get to the crossover point in month 13 where all of a sudden you're profitable, and that customer is contributing to the business and offsetting the customer acquisition cost, right? So this is kind of like 101 stuff, but it's an important concept to understand, because when you go to the next slide and you take the single customer example and you start ballooning it and multiplying it out and saying, what if I start adding customers at 2 per month or 5 per month or 10 per month? So a company that's adding customers, you know, 10 new customers a month with this exact same profile, you think, you know, that's a good business. You're getting momentum, you're getting customers. But look what it does to your cash flow. Right, you start here, and as you're getting more customers, you're losing more money, you're burning more cash, you need more capital to fund your business and grow. Versus if you're growing a little bit slower, you need a little bit less, because you do get that crossover point. So it's a funny thing, because as you're getting more customers and you think you're winning, you know, you got to educate your investors and say, listen, this is a good time for us to continue to start executing and burning more money, because we're actually, the unit economics are working out. We're actually growing our business on a sustainable basis. So that's an important thing, and it's always a balance that you have to get that messaging across to the investors to make sure that they're, you know, fully up to speed with this, because, you know, what looks like a cash burning, negative business is actually a very, very great business, right? So that's kind of the high level in terms of the SaaS business model. Now, there's a lot of numbers here, but I'm just going to focus on some of the key kind of concepts in here, right? So, you know, from a unit economics perspective, couple of key things, right? Your LTV to CAC ratio, and as Craig mentioned, lifetime value to customer acquisition cost. What did it cost me to get that customer, and what's that customer worth to me over the long haul? And you know, so it's a fundamental indicator of the strength of your business model, because if you have, you know, an LTV to CAC ratio of 10 to 1, that's fantastic, because you spend $1 and you get $10 back from the customer over the lifetime of the customer. So that's a great business model. So the things that impact the LTV to CAC is obviously your churn and MRR. That impacts the numerator, and your cost to acquire the customer impacts the denominator. The other key metric that you have to look at is the months to recover CAC. So if I spend $6,000 to acquire that customer, and I can bill them $500 a month, right? It's like it takes me 12 months to get it back at $500, right? So that's your months to recover. Craig and I were in a business where our months to recover CAC was more than 12 months, right? So we had to consume a lot more cash, but the LTV at the time was crazy, right? You know, we would only churn a customer if they went bankrupt. But that's a hard thing to explain to investors, because it's like, yeah, I'm in year 1 of my business model, and I think I have a 10-year life with my customers. It's like, okay, good luck with that, right? So, but that's the reality, that, you know, if you're in a situation where you have a very sticky business model, you got to argue that point, you know, very, very, you know, intensely and passionately to get the investor to understand, I do have a low churn business and my LTV is long, right? It's hard to prove in the early days of the model, but if that's a use case of your business, you really got to get that point across. And so, you know, really quickly here, there's 3 broad areas that you look at, right? One is like keeping customers will impact your CAC, getting more revenue per the customer will impact your LTV to CAC ratio, and reducing the cost to get customers impacts your ratio. And so what I wanted to just illustrate here was that using the same fact set, right? We have an LTV to CAC ratio of 2.8 is the base set here. And on the first caption there, keeping customers, if we decreased our churn from 3% to 1.5%, your LTV to CAC ratio would go from 2.8 to 5.6. So that's one way you can get from increase your LTV to CAC ratio, is reduce your churn. Keep your customers longer, and therefore they're worth more, right? The other way you can do it, again, in this section here, I wanted to illustrate keeping all the other assumptions equal and just focusing on MRR. If we increase the value of monthly revenues from 500 to just over 1,100, you could go from 2.8 to 5.6 again. Much, much harder to do, right? How are you going to go out there and double your revenues, right? I'm just indicating kind of relative kind of impacts and difficulty. The final one is reducing the cost to get a customer. So in here, we have $6,000 as our customer acquisition cost. If we reduce it to $2,500, then you get from 2.8 to 5.6. Right, so the answer is not any one of these things. It's a combination of all of these things that you have to do to continually drive your business to reduce your customer acquisition costs and to improve your unit economics. So it really is a combination. And finally, the other thing I wanted to mention too is as you're measuring your metrics and you're looking at your business model, You may have different channels to bring on customers from radio, it could be pay-per-click, it could be, all sorts of different stuff to drive traffic to your website. And you could have an inside sales organization that's going out there and selling and, engaging in higher touch. So in this slide here, we talk about low touch, which is more like online automation, drive people to the website and get them to convert, get them to register, and then you convert a registration to a paid customer and all that stuff in that funnel or that kind of flow. And then the other section, it's high touch, right? Where you have your traditional inside sales guys going out there, reaching out to the more highly valued customer that have a higher potential LTV. They just need a different buying process in some cases. And so you want to treat them properly and give them the high touch that they need. And so the key messaging here is that every channel, you should measure your metrics by channel. Because, just to stay in the online world for a second, if radio is giving you a customer acquisition cost of $500 and your pay-per-click spending is bringing you customers at $1,000, where are you going to invest your money, your marketing dollars? You're going to invest it in the $500 one, right? So you don't know that unless you disentangle kind of your spends and you try and allocate it to the programs and match that to your customer acquisition. It's a hard thing to do because your marketing person will tell you attribution of your customers and where you get them and hard, but that's something you should always strive to do. And it's not about getting it perfect, it's about getting it directionally right, because you'll know that radio is better than pay-per-click or whatever from a directional perspective, and then you keep feeding the winners. And then on the high touch perspective, in this low touch, it could be a CAC of $2,000 is what you spend to have this kind of customer here. In a high touch where the customer has a much higher value, you could spend up to $20,000 to acquire that customer. So you can spend different amounts to acquire different customers based on the relative value they bring to you over the lifetime of being a customer. So that's a key message here. And Craig will talk more in terms of the sales metrics on low touch, high touch, and the different things that go into kind of some of the key sales metrics that you should be looking at.
I think I do that now. So I wanted to talk about sales metrics and some of the levers that drive those metrics, starting off with low touch and then moving to high touch. I first wanted to get a sort of a hands up in terms of who here is in a low touch SaaS business. Okay. And so, and who here is in a SaaS business with one inside sales rep? Okay. And the rest are so, and who in this room has more than 5 sales reps? Does anyone have more than 5 sales reps? Just a couple in the back. Okay, so interesting. So as you grow the organization, you generally, of course, add to the sales team. But in a low-touch environment, that's generally not the case. In a low-touch environment, the holy grail is to automate as many processes as you can. And so there's 2 effective ways of marketing. One is by pulling, and the other is by pushing. And a low-touch environment is really going to gravitate towards pulling. That would include advocacy-based marketing, so using your customer base to refer business to you, using your customer base to give you testimonials. It would include using content, obviously, to your advantage. Content is a big word these days, a big word in marketing. It's all about being credible in your space. It's all about having high search engine results. And it's all about amplifying that content through social channels. Right? So essentially what you're doing in a low-touch environment is you're driving people to your application or your website. And so one of the key metrics down the road is going to be number of people that visit your website to number of conversions to customers. Right? But once you drive them to your website, then there's the acquisition process. Now in a low-touch environment, there are lots of analytic tools that are available to you to see everything that is happening in the environment. And as a SaaS organization, you should understand the metrics that are critical to drive your business, and you should live as an executive team live and die by that dashboard, right? And that's all based on what happens on the website. You can actually get information now, as you probably know, of time spent, where they went, what was their journey on your site, how far down the page did they scroll, how far into populating data did they go before they abandoned. And so by getting these metrics and then using levers to adjust, maybe providing a different offer, maybe moving the boxes around, trying different colors, you can do different landing pages, you can rotate 2 or 3 tests, see which one works most effectively, and then roll out with the best. But you want to have those metrics in a low-touch environment, just as you do in a high-touch, it's just that they're different. And then, of course, you're going to move into the conversion of a customer. And a conversion of a customer is what drives MRR. And the recurrent revenue, as I mentioned, it's really what you're really aiming for is the recurrent revenue in a SaaS organization. It gives you the foundation to really rocket into the future. And over time, you'll calculate a lifetime value. So Wilson mentioned we did have a company that really we had zero churn. I've also been in a SaaS company or consulted with a SaaS company that 3 months we had 20 customers, and 5 months after that we had 3. And so, you know, it's a bit of a panic when that happens, when people aren't seeing the value of your platform. So in addition to monitoring activity on your website with analytics, it's critical that you monitor activity in your application as well. So you want to start to see how often they're logging in. You want to see if they're providing you with data. If your application requires some sort of data to be input into your tool to work better, and they're hesitating to do that, that's a problem, because it won't be as sticky as if they input data. So you want to watch the patterns that are happening on the application, and you'll see over time where people are churning out. And so hopefully you'll get metrics in place that will help you identify low activity, and you'll get proactive about contacting those customers, having a dialogue with those customers before they pull the, you know, we're not going to pay you button, which is always a bad thing, churning out of the business. From a high-touch business, really we're getting more into a database acquisition. So there is pull marketing as well. I mean, there's nothing sales reps like more than having leads fed to them by the marketing team. They're always looking for more. But really you're basing your business around the database. You should have a CRM tool. And there are a lot of options out there for CRM tools. The last company I was consulting for, we paid $10 a month for. It was called Nimble. I've used Salesforce. I've used SalesLogix. It doesn't matter what you use as a startup, as a SaaS organization startup. You don't need a lot, but you need enough, and you have to be disciplined about feeding it with all of the data. And I was talking to Wilson about this. Sometimes it's difficult to get people to feed it. I tried being a nice guy, getting people to put the data in. That didn't work. So then I withheld commission checks, and that worked. They started putting the data in the platform. So in a high-touch environment, in a high-touch environment, the acquisition now is really a sequence of events that should be a discipline within the sales organization, because if they don't follow a proper sequence of events, you get to that point where customers go dark, and you know, or they just stop returning calls, and that's because you didn't qualify. 9 times out of 10, from my experience, these deals go south because they're just not qualified up front. And so you want to make sure there's a process in place for qualification. And as they move through that process, you're going to move them towards close, and that'll give you a more accurate forecast. Because again, you have to have accurate forecasts, and you need metrics to do that. When you're sitting with potential investors, when you're sitting with someone who's looking at your organization, you need to, with confidence, show them those numbers. And you need to be able to pull them out on a dime, too. It shouldn't be an exercise where you scramble to put together Excel spreadsheets. It should be something that's fed all the time. So that's absolutely critical. On the conversion, this is where you really get into looking at win-loss. And so from my experience, when you move them through the pipeline, you should have a win-loss rate that's anywhere from 35 to 55% win rate. And if you don't, because generally speaking, buyers are going to look at 2 or 3 companies when they're doing an analysis, you want to win, right? And so if you're at 55%, that's ideal. You should try to win more than half. But depending on the environment you're in, anything greater than 35 is okay. You look at things like pricing, average revenue per customer. So both in low and high touch, you'll be adjusting pricing, but more so in high touch, because a lot of times the rate card's held, you know, under the kimono. They can't see it. And so over time, you will continue to perfect that, and that'll become part of your intellectual property. Rate cards are really a work in progress, and it can take years before you get it just right. In terms of lifetime value, the same metrics apply for both. You're going to be looking for client feedback. If you're in a channel model, it's a little more difficult. I've always recommended to companies that they try to have relationships with about a handful at least of customers themselves, just so they can get feedback from the customers, understand how they like the application, get feedback from a real client rather than just through the channel. And then finally, we're going to talk briefly about churn. One of the points here is the cohort analysis, which is which is really a way of saying when you bring customers in at a point in time, you should group them at points in time so that, again, down the road, you can look at your churn and you can see when you brought customers in, was there anything happening with that group of customers at the time that are churning out relative to the customers you brought in the next time? So maybe you had a promotion, maybe you had some sort of sales incentive program, maybe you were doing something different from a marketing perspective, and although those customers signed up, maybe they churned out earlier. So this is another metric you can look at. And then talking about churn, I was looking at this, let's just hit enter maybe. I was talking about this, I was looking at this slide last night, and in terms of churn, I think the most important lever you want to be looking at is this, implement early warning systems. And so how do you know customers are going to be thinking about churning out? How can you predict that? And you can predict it by looking at their use of the tool, by by getting their feedback from them. And so we were just wondering here, has anyone, I mean, churn is one of the biggest issues in a SaaS organization. You never want to lose customers. Does anyone here have a story of churn and how they have addressed it from a product perspective or from a customer service perspective that they'd like to share with us? Somebody must. Yeah. Right on.
Is everyone familiar with the Net Promoter Score concept? I mean, people use it a lot, and I think it's a great metric. We work with a lot of companies that are using it as well, right? And you focus on your enthusiasts versus the detractors, right? And once you get into negative Net Promoter Score, that's a bad thing, right? Bad place to be. But certainly the ones that are very, very enthusiastic about your product are great customers. Are there any other examples or stories or processes that you're using? Because as Craig mentioned, churn is, it's one thing. It's like the leaky bucket story, right? So you keep filling the top of the bucket, but if you leak out customers through churn on the bottom and then you're turning 25% of your base every year, you got to put 25% in the top just to kind of keep it even. So that's a very, very critical element. So if you wouldn't mind just standing up, and I'll see if I can reach you and hand you the mic, but.
So what we've found that really helped our churn over the last year and a half is proactively looking at the product usage. Churn was higher than we wanted it to be, and we got our account management team to start proactively looking at the usage stats and looking at the out 6 months and looking at renewals. So we got annual contracts, looking out 6 months, what's the usage? Someone doesn't have the usage where it should be, what's happening? Let's reach out to them. Has someone left the firm? Has a key user left the firm, or many users left the firm? And reach out to the customer, and we found that's really helped. It's dropped our churn in half from a double-digit number to a much lower number, and it continues to improve today. So, I
don't know if I can get to you. Do you want to just stand up and? Do you want to?
Hope that was worth waiting for. Paul Clark, Blue Cameroon. More an observation than a history. We obviously do the kind of things, tracking engagement, tracking usage, to see a customer at risk of departing. But really an observation that in terms of measuring churn, early churn and late churn are different things. So we would say, for example, a customer who leaves within the first 3 months is a failure of onboarding, as opposed to a customer who leaves after a year is maybe a failure of product fit or something like that. And you've got different interventions needed for where your churn is high.
Certainly for the customers who sign up. Is it on? For the customers who sign up to annual contracts, making sure that they renew is fantastic, right? And when you know a customer is going to renew and they're up for renewal within the next 90 days, and and measuring engagement, measuring kind of interaction with the application or whatever, and just reaching out to them and showing them getting the customer service group engaged with them to make sure that everything's okay before they renew, if it's a high value renewal, is also kind of very, very interesting to do for the later churn ones. But your point on the early churn one, I think, is very well taken.
Right. Asked Wilson a second. It's really the same. You look for the same things. I mean, when you start in a tech startup, a lot of companies in this room may not have started with a firm contract, or maybe they have an annual contract, but it's got a 30-day out. After you become established in the marketplace, you have the greater. I mean, when Salesforce launched, it was month to month. Now it's an annual contract, take it or leave it. So even though they're not signing a contract, all the same observations still apply. If they're not using the tool, if the customer's reporting back is unsatisfied with the experience, or if there is no experience, from what I've seen, it's generally just lack of use. That's the biggest problem, right? Or if they're not uploading their data. So for you, maybe you implement a process over a 30-day schedule to work intensively with that client to get them using the tool, right? So that it becomes habit for them. If it's just you got it in there and they know they could get out, one thing is they're not maybe that qualified, and the second is back to onboarding, they have to have an experience those first 30 days that's going to make them want to continue to revisit the tool.
I would just add, like, from a contract perspective, at a minimum, it's the CFO in me now, right? So that you should, so you should have, at least some terms of service in the cloud, right? And so when you sign them up to whatever piece of paper that they're going to onboard, or they click accept, right? That there's some terms of service that protects your IP and all that type of stuff, right? And there's minimal kind of terms and conditions, right? So you should, at a minimum, have that to protect your intellectual property. Question back there?
It's working? Good. My name is Zach, and I'm with a company called Lupia. So we're just in very early stages right now, so we're building a foundation for a lot of product metrics. But the story I want to share, so the previous company I was at, Achievers, and what we had built out to measure product engagement to predict churn and engagement was kind of a customer success score. So, you have all these metrics that feed into product engagement, but we actually took this idea from Hubspot, because we were good friends with that company, and consolidated everything into a single customer success score, which measured engagement, and we automated as much as we could. But the next level, which I think is kind of thinking outside the box a little bit, what HubSpot did was actually took that customer success score and gave it back to the customer, and then showed them how they were doing versus all of their other customers. So if you had this engagement score and you say, oh my God, I'm not using HubSpot as much as all these other customers within my industry, I could be using it more, and you kind of gamified the engagement a little bit. And that actually worked very well for them. We never got to the point where we exposed those scores to our customer, but I think if it's something that makes sense for your industry and you can actually consolidate engagement into something a little bit more fun, and then expose it to your customer and see if you can benchmark them against your other customers, that could work for you.
Hi, Harp from Bright Iron as well. I'll share some experience as well over at, with my experience at Virgin Mobile and Virgin Gaming as well. To that last point that you sort of just said, I think an emerging theme is that the concept of cost of maintenance. So we've talked about cost of acquisition and cost of maintenance. If there's a budget that's allocated towards that, and talking to a finance guy, you should probably get that. It does actually very much so help help churn. So what we sort of did was, even at Virgin Mobile, we looked. And the big guys were like 200.
Right. Yeah.
Yeah. Well, there's a senior guy that made the decision to put it in, and his job's on the line. Works, right? He's got to make sure it works. Yeah. Okay.
Any more, or maybe we'll just.
We got a couple more slides. So we're going to flip to the next slide, but I guess just one last point, which is, everybody should have a dashboard. Everyone should have their metrics. And the way I've always started in companies, not always, but I figured it out after one, was that you start with the reports. Just as a team, mock up the reports that you want. The capability to get it to you is there. But first, don't start with the data and try to figure it out. Say, how am I going to run my business? What are the key metrics? Put them down, scope them out on a couple of spreadsheets. Maybe there's 5 key metrics or 10 key metrics or 3 dashboards, and then put the systems in place to provide you with that data. It's just an easier way of approaching the problem.
So just to kind of keep moving on. So just to kind of wrap it up a bit, is So building a SaaS company, having done it a couple times, right, it's a marathon, right? And you got to capitalize your business for the long haul, right? Because it was in the days where you could sell perpetual software and you would sell a deal and you'd get $1 million contract. That's $1 million of cash, right? And then you had your 20% maintenance. That was okay. That was a good way of generating cash, and a lot of technology companies grew that way. But nowadays, you take that $1 million and you say, okay, let me slice it up into 3. So I'll take $333,000 a year for hopefully more than 3 years, so that you're actually ahead of the game on the long-term basis, right? But that's just a much different kind of cash flow kind of scenario that you're facing versus the older model of traditional software licensing. So, capitalizing yourself appropriately is super critical, right? And you will need, for the aspiring companies that we all aspire to build companies and take public one day, right? So you'll need the multiple rounds of financing. So you'll have to have the things that Craig mentioned, which is, a sales pipeline and forecast that you can press a button and deliver out there that's accurate and credible, because investors are going to want to see that level of predictability. And all the key metrics that we were talking about in terms of the lifetime value to CAC ratio. What is your CAC? How is that trending? Measuring it by segments, right? So how's my radio performing versus my pay-per-click and all the different channels? Getting to that level of granularity is just going to inform you and educate you as a business owner and managers, right? To make sure that you're making the right investments in the areas that are going to drive the most profitable growth in your business.
Okay, and on the last 2 points, last night, kind of apropos, my wife came home. She's taking a course in Lean Six Sigma. And I guess at U of T, and I guess the professor said, you only learn when you fail. So I don't know if that's true. We discussed that for a while. But certainly the point is, you have to keep trying stuff and you have to get involved. And along those lines, along the spirit of that line of thinking, BDC will be having follow-up events, which are workshops to get people more involved. And leveraging our experience. There's no point you have to learn everything through failure. You can also learn a lot through our experience. So Wilson and I, Bright Iron, are available for a coffee, available to sit down and chat with you about any of the challenges you're facing in your business, and we would love to talk to you about those challenges. So I'll leave it at that.
So that concludes kind of the formal presentation part. It's just a bit of an infomercial on Bright Iron, who we are. So again, we're very focused from an operational advisory perspective on the strategic financial function, as well as the sales leadership function, and also have a corporate finance capability as well to help companies that are wanting to get ready for the investor rounds and kind of position themselves appropriately. So to the extent that you want to reach out to Craig and talk more about the sales side, feel free. He's got some contact information here. I think we've got it also in the handouts, and myself as well on the finance side. So if there's any questions, I know we talked at a very, very high level, so this next kind of few minutes here is just to open it up to anything on SaaS, right? So if you guys have questions, we can go a bit deeper in terms of topics.
My question's around the ACV, and when do you actually calculate, and how do you calculate that? Because in our situation, we have monthly and annual contracts that we sign, and then about 40% of our customers add more seats during the year. And so, to peg it when they sign up is completely wrong, and given annual and monthly is wrong, and then upselling changes that number again. So what's a good methodology
The
of
key
dealing with
metric
that?
in SaaS is use this mic here. I think the key metric in SaaS is all about new MRR, right? So everything boils down to how much new MRR am I getting, and it's all about cash, right? But MRR is how you collect, how you get the money, right? So as you're selling and you're getting new monthly recurring revenue, that's showing the health of your growth of your business. That could be through upsells because it's new through an upsell, or it could be net new because you're just getting a new customer, right? So that metric is showing kind of the growth in your business, and then investors will look at your new MRR and they'll just multiply by 12 to kind of figure out what the ACV is, right? So they always just look at the monthly recurring piece and then multiply it by 12 and say that's the revenue run rate on an annualized basis. In your specific question, I think, again, it's going to vary for every single business, but you got to just segment your base, segment your customers, and then start measuring them, because you'll have a hypothesis that in your business, I might not get it all right, but in your business, your 100 to 200 segment enterprises, right, where you could sell into it, could be, your hypothesis is it's worth X from an ACV because I think my normalized penetration rate should be this. right? So then you have to create a hypothesis. What's my cohorted segment looking like, right? And it's not any one individual. It's kind of like in a cohorted segment of my 100 to 200, company target. I should expect this. In my 1 to 10, I might expect something smaller, right? So, but by getting a bunch of companies grouped in there, you'll start to come up with a normalized ACV for each of the categories. It takes time, but I think that might be one approach that you might consider in your business. Is there any other kind of questions on SaaS, unit economics, CAC? I mean, we have to wrap up soon, but okay, all right, okay. So, anyone else have any other kind of questions that you want to talk about, or? Yep.
I'd just like to get your perspective on the difference of consumer versus business clients.
So the B2B or the B2C, right? I was looking at HubSpot went public, right? As we all know, and it was a great success, billion-dollar valuations and whatnot, and all sorts of kind of analysis and data started coming out of that, right? And so I was reading a blog and it showed what's the average size of kind of contract values, customer values across a bunch of different SaaS-based companies that went public. And it was funny, but on the lower end, you would have probably the consumer stuff, right? The B2C, because it tends to be at $49.99 a month, right? It tends to be a smaller kind of ACV type of product. And on the higher end, you would have larger enterprises. And HubSpot, surprisingly, was at the I think they were one of the bottom 4 companies in terms of annual contract value. And for them, I might not get the number perfectly right. I think it was like $6,000 or $8,000 or something was their annual contract value, right? But that was the cohort of a bunch of graduated SaaS-based businesses that went public, and the smallest one was in and around the $6,000 to $8,000 per year range in terms of customer size, right? And there was some smaller ones, but to really build the very, very big, large, companies that go public, the sizes of customer tend to be larger, so that would skew a little bit more towards the B2B that could write bigger checks. This is it's kind of a generalization, right? There's always exceptions to the rules, but that's my thoughts, I guess, on that. So.
Sure. I'm going to. Can you maybe share some thoughts on freemium versus try and pay, the differences?
I mean, careful what you wish for, right? If you offer freemium, because you might get a lot of customers that that never buy, but they use your product for free, right? So, I mean, there's a split, right? Pacific Crest issued a report. I don't know if you guys have seen it, but if you haven't, I encourage you to look at it, because it's a great report that basically profiled and surveyed about 300 different companies in the SaaS space, and they talk about the freemium versus the free trial, right, and the pros and cons. I mean, so from some of the companies that I've been involved with more recently, they had a free trial model where they were bringing in customers and they were allowing them to use the product for free. And then they switched and they stopped that. And they said, you know what, we're not going to do that anymore. We're going to go to, you have to pay to use the product, but we're going to offer you a 90-day money-back guarantee. So you're a customer now, and if you're not satisfied with it, within 90 days, we'll give you the money back. And so what they ended up finding was that switch for their business actually made it way better, right, for them. Because, you'll always have the people who are going to come in and try the freemium. And again, this is a generalization. This is one use case for a company, right? But they just, in their situation, they found it better because the types of customers they wanted to get serious customers, and there was a little bit of cost to the freemium. Theirs wasn't very low cost, right? So because of that, they became a little bit more selective in terms of offering freemium, and they got rid of the free trial. If you have a business model and a cost to acquire, and your cost to serve, let's say it's a storage solution like Dropbox, perfect, right? If your cost per gigabyte is like a penny, right, to kind of deliver and store stuff, and it's not going to cost you much, and you can kind of give them limited usage, right? And then you can upsell them once they go beyond a certain amount, then that's a great business model. It all depends on what your cost is to service that free base, right? If you can do it cost effectively and you can measure the conversion rates of your free to paid, and then you're basically looking at your free base as almost like a customer acquisition cost for your paid base, right? So you just have to look at the cost of what you have to spend to maintain that side, and that's basically a funnel for you to get converted paid customers. Okay, I think we're about ready to get going. So first of all, again, I'd like to thank Denicia in particular and BDC for hosting this session here on the investor panel, and also thanking the investors for coming out and participating here. Hopefully we'll get a lot of great insight from them for you guys to use in your tool chest going forward. So just to kick it off, what I thought would be great would be to get each of the investors here to introduce themselves and tell you a little bit about their firms and their fund and what their kind of investing criteria and mandate is, just so you can get a sense for what what segments and stage of companies they invest in. So having said that, I guess we'll just start, and if you want to pass the mic to Daniel, we'll get him to kick it off.
All right. Thank you for having us. And I just want to say I'm learning a ton from this event, so this has been great. So we are a growth equity fund that focuses on software companies. I've been investing in software companies for a long time. Realized how long it takes to build a really early stage software business. So we've moved a little more upstream, where we're looking for businesses with revenues scaling. We do three things. We provide growth equity in the $2 to $10 million equity check range. We buy companies now up to $20 million of equity in terms of our buyout fund, and we also provide royalty financing, where we go to a company and provide a third of the revenues as a equity investment, where we just take a percentage of the revenues until you hit a cap, and then our equity falls away. And so we're not part of the shareholders agreement, and we're also not part of, we don't have to deal with valuation or anything like that. So that's a product that's just taken off as well. And we're backed by Hoop as one of our biggest investors, which is the Healthcare of Ontario Pension Plan. And fortunately, now we're using a lot of our own capital as well. So we take a much longer term horizon in terms of building our businesses.
So I'm Matthew Roberts. I'm the Associate Director in the BDC IT Venture Fund. So we are focused entirely on software investments. We focus primarily in the early and mid stage, so seed and Series A predominantly, and opportunistically we'll do later stage rounds. We'll invest in the full gambit of software. It can be mobile, enterprise software. Our current fund is about 75% focused in on enterprise software and 25% on consumer. We've been in this fund for about 3 years, $150 million, and we're probably about 70% of the way through the fund right now.
Great. I'm Alex Baker with Relay Ventures. We are a Toronto and Silicon Valley-based fund. So we've got two investment partners here in Toronto and two in the Valley as well. We run 150. We're currently investing out of a $150 million fund. It's focused on mobile applications and everything we would say from the cloud through to the sensor. We typically focus on Series A deals. We'll do a fair amount of seed investing locally, both here in Toronto and in the peninsula. And then ultimately, to lead us to a Series A, we'll invest across all kinds of business models, whether it be consumer, enterprise, focus, could be a SaaS business, could be in fact just a land grab play on the consumer side. And we take a long-term view on our investments, believe that it's an 8 to 10 year horizon at minimum to grow big businesses and scale those businesses. We also reserve on at least a one-to-one basis for each of our companies to make sure that we've set aside enough money for growth and look to take very active roles in companies, being on boards and helping with hiring and business development and all the things that early stage companies need help with out of the gate.
I'm going to start this a little differently. In Bay, can you hear me back there? Okay, so I'm giving you responsibility for, if you can't hear us, to jump up and say, speak the up. And if you don't want to hear us anymore, you can also say, shut the up. All right? My name is Sandy Scott. I'm a partner at Tandem Expansion. Tandem's a $300 million fund in Canada. We call it technology growth equity in Canada. So we would prefer to write sort of a $10 million check into a company a little later stage and across technology broadly. So we do stuff outside of SaaS and software all the time. But in SaaS specifically, since that's the context here, if you're run rating $6 to $8 million in revenue, 75 plus gross margins, and that revenue is sort of diverse across a large number of customers, you've probably hit the threshold where we would be interested. So it's a little later stage than most, but that's where we play.
That's great. So it's just for the format, just so you know. So I've got a couple of themes and questions that I'm going to ask the panel. So we'll run through those first, and then at the end of it, we've got a section set aside for a Q&A to kind of make it an open mic session for you guys to ask direct questions to the investors. So the first question here is for Matt and for Alex. And so for the two of you, what are your thoughts on the current financing environment for early stage SaaS companies? And are you seeing any trends with SaaS companies looking for financing?
I'd call it frothy. It's the polite term for it, right? Or as some of my partners have called it, crazy. The valuations are significantly higher than they have been, just 3 or 4 years ago.
Make note of that, guys.
So that's good and bad for everybody involved. The trends we're noticing is our actual real viable businesses coming online right now. So we're not seeing, the next Instagram knocking on our door, trying to, do something with nothing and not charge anybody for anything. We're seeing a lot more viable businesses being built online and showing real growth and real thoughtful processes and how they can continue to sustain that growth. So it's actually quite positive if you look at it from that point of view.
Okay, thank you.
So I would agree. I mean, things are extremely frothy right now, and I think the public market's cooling down a little bit. It's going to absolutely have a trickling effect on every startup that both we're investors in and looking at, and those in the market today. But on the flip side and on a business model side, Wilson, I think the most important or interesting thing that I've seen over the last 8 years is really, we have not looked at a company that has an enterprise license model as its business model since probably 2009 or 2010. So any company that's coming to us that's selling to enterprises is coming to us with a SaaS model, and that obviously requires a ton more capital than it did in the past because you can't fund your operations with large upfront fees. But that being said, this is the viable model. This is the go-to-market model. This is the model that I would say every B2B company is basing their sales on.
Okay, thank you. Yeah, absolutely. Yeah.
So I think, even though it's frothy, I think there's a lot of money chasing very few deals, and there are a lot of deals out there that are not getting funded. And if you look at some of the larger venture funds in Canada, they've only done 1 or 2 deals this year. And so I think, the challenge is really the companies that have proven themselves and they got 2 to 4 or 5 million sales growing at 20, 30% and don't have that growth curve that other people are seeing. And so I still think it's always hard to raise money, but I think those companies are really having a hard time raising capital today.
Okay, so the next topic I wanted to ask about was, a series of questions to help the entrepreneurs in terms of raising money. So, Sandy, I'll kind of direct this to you. So what are some of the key SaaS metrics that you look at, and given that it's later stage, but I think it's applicable to the earlier as well, that you look at when evaluating kind of your investment, and what makes a SaaS company stand out in your mind?
Sure. So I'm first going to say, Wilson, you covered it really well an hour ago. So all of the metrics you talked about, LTV, CAC, the ratios, all that stuff is critical. When you get to my stage, which is a little different than the earlier stage, I find 2 things actually get me over the hump and are the things that get me excited about businesses. The challenge at the stage that we're at is often you've sort of figured out the first channel, the first go-to-market, and it's kind of working, and so you think you have it sorted. And what you don't realize is that there's no depth to that channel. And so your cost of acquisition is $75 for that customer. And you think, well, if I had an extra $10 million from Tandem, I could just increase my spend by 10x and I'd still have a $75 CAC. And you're wrong, right? Because there's no depth to that channel. You can't 10x the amount of spend you have in that channel and still have the same CAC. So depth of channel and diversity of channels is one of the things I love to see. People who are running experiments constantly, even though they have one channel that works really well, they've got a whole set of other things they're trying out and they're starting to get progress on those things. It's critical. The other thing I would say that I look for is an understanding of actual versus potential LTV. So most businesses sort of have this sense of, we do an amazing job of running funnels from the starting lead or even visitor to my website point all the way through to closing a sale. And it's amazing how bad the sophistication is after that point. So you've actually closed a customer now. They're using your software, and you're not spending a whole lot of time trying to figure out how do you get them to spend more money with you. Right. And so I look a lot at the way a company is approaching, managing their current customer base, how they're going to monetize that customer base more effectively, what they see as potential for adding either new seats or new functionality or raising the prices or whatever those things are to try and increase the potential LTV of their customers over time. Those are the two things at my stage that I spent a lot of time on.
That's great. And did everyone get that? It's an important point that Sandy made in terms of depth of the channel, because it's one thing to say, hey, I've got a customer acquisition cost, my marketing budget's $1,000, and look at how great I can optimize that $1,000, right? Because you can get pretty optimal at $1,000 spend, but magnify that to $1 million, what does your CAC become, right? The efficiency, you got to be able to scale that spend to make sure that it scales from an efficiency perspective, and your CAC all of a sudden doesn't balloon up. So that's a great point. Working down, Daniel, do you want to kind of add some points to this as well?
So I don't even know what LTV means. No, I'm just kidding around, but I'll leave it for Wilson to look at that math. I mean, we look at it as a bit of an art and not a science. I'm not a technologist and investing in technology companies, but I'll look at it and say, if you've got happy customers, your technology works. And so I don't care how much you look at the technology, and if you've got happy customers, it has to work. And so I look at the same thing on the math. I look for entrepreneurs that have been really efficient. I mean, it's a definition of an entrepreneur, right? Someone that doesn't have a lot of resources and able to do something pretty spectacular. So when we look at it, when I look at any company, I'm looking at an entrepreneur that's been able to do a lot with very little. I'm looking at the customer base and whether they're happy and being able to retain their customers. And then I'm looking at if they've got a repeatable business and they're able to add a certain amount of customers every month. So if you have a company where you're selling $4,000 or $5,000 a month in recurring revenue, you're able to add 4 a month. I look at that, and typically what I see in the companies that are $1 to $3 million of revenues, if you're able to add $10,000 to $20,000 a month in recurring revenue, you're pretty damn good. And so I look at it that way. And then the third thing I look at is I still look at the mature software companies and as a metric. And I learned this from one of our partners in our office. If a software company is growing at 30% and break even, that's a really good base and good metric. So if you're a $10 million software company, you're making $3 million a year, you're really good. If you're making no money a year and growing at 30%, then you're really good as well. So if I come across a company that's growing at 30% and making money, or growing at 50% and break even, I know they're exceeding or best in class metrics. So those are the kind of things I look for.
Thank you. So the next question for Matt and Alex is, so how important is having a credible financial model, unit economics to your investment analysis, and in your opinion, what SaaS metrics are must-haves in a financial model that you guys look at?
Sure. So at the stage we're investing at, like particularly at the seed, financial models are interesting, but they're completely unrealistic. And more or less, they give us a sense of the type of entrepreneur that we would be investing in. So, are you a person that's extremely conservative and telling us that in the first year you're going to do 5K or 7K by the end of the first year in MRR, or are you a person that's going to tell us you're going to do 50K in MRR and growing at 40% month over month? So it just gives you a flavor of the type of person that's presenting to you at our stage. I think, at least for me, and particularly at the seed, when you start to get into Series A, you look a little bit more at this. Daniel talked about the 10K to 20K growth month over month, which is important because it means that you've got some type of repeatable sales process. The one point I would add is that in general, when I'm looking at Series A, which I would call later stage, although Sandy would refute that, when I'm looking at at Series A, quote, later stage in a SaaS company, I'm typically looking at trends in 3-month increments because it still is lumpy revenue. It's still coming in as lumpy revenue, and you may have one amazing month and you may have one horrible month, but that's just because your resources are somewhat constrained. You've got a small sales force. You may have had to let someone go or they've quit, and one person leaving has a massive impact on you. So I try to look at things on a quarterly basis over time. Month over month is obviously very important, but smoothing it out a little bit gives you a little bit of a better sense of the trajectory of the business.
I'd just reiterate that we, in our seed, in the deals where I look at in the seeds quite a bit, we're doing on a month-to-month basis, and I'm looking for a semblance of understanding of how they've had that kernel of success earlier on, and if they're modeling that out in their process. When we get into the sort of maybe a year after the early seed deal has been done, and we're looking towards an A round deal, I'm looking at the quarterlies as well, but we're also looking for seasonality in the business, because a lot of businesses, even though they don't suspect they are actually very seasonal. And it can be very lumpy as to whether or not their business is actually sputtering, or whether or not it just happens to be part of the season. So we look for that in our deals as well when we're providing advice.
That's great. Thank you for that. So this next question is for the entire panel, and it's one that hopefully can give you some good insight. So you've all done a lot of investing in different companies, and in particular, on the SaaS companies that you may have invested in. If you could share some of the lessons learned and things that you saw that made that SaaS company successful that you can share with the group, I think that would be some invaluable insight for the audience here.
So almost every company that after we've put in an A round into them that's a SaaS business has watched their their CAC costs go through the roof. It's a consistent trend. It seems to be that they double down on what we were talking about earlier, where they think they can just throw money at the same marketing channel and then it doesn't work. So they have to be more thoughtful in their marketing expenses. Probably should think very thoughtfully about who they hire to do that for them too. Usually they're dealing with a guy who's just an SEO or an SEM guy, but they haven't really thought about it I have to bring in a director or a VP of marketing. That should be their first hire after they've raised the A round, rather than maybe just trying to give more money to the kid they hired who was 23.
So Wilson, I think you said this before, like in B2B, free has not worked for any of the companies that are SaaS companies that we've invested in. Free has just not worked. All it's done is it's provided a protracted sales cycle. It's increased it actually has increased the cost of acquisition, because you're generally running after people who will never be your customers, and getting customers into a sale earlier on. It might take a little bit longer. It might be a little bit harder to get them into the customer count. But it's way more sustainable, and they're way more engaged as customers. So I think that is a massive takeaway. The market, I think, has really shifted away from freemium, particularly on the B2B side. If you're talking about a recurring revenue model on the consumer side, I can't really comment on that. The majority of our investments are not SaaS, consumer SaaS, but I can tell you on the B2B side that's been a real strong trend. The other trend is when entrepreneurs come to us on a Series A or even on a seed and say, like, I've done this growth, I've gotten to this point in revenue with zero spend in marketing, that's generally a sign that it's a load of crap. Okay, it's impossible that $0 have been spent on marketing, because whatever your sales costs are, they would be outrageously high if you allocated your time as a CEO or founder to sales, and part of that would be marketing as well. I mean, it does cost money. The third thing is explore every channel. So we've got an investment locally in a company called ClearFit. They are heavy SEO, SEM focused, and then I'd say in the last 8 or 9 months, they've started to focus more on alternative channels. So if I was to come in here 8 months ago and tell you that they've started XM radio ads, and I think that they're going to be successful, a lot of people here would probably shake their heads and say, like, XM radio, like, who listens to that? The fact is, it's been an extremely efficient way to get a message out. It's been an extremely efficient source of acquisition cost, and it's been underutilized by other businesses in the same space as them. So I'd say, like, test everything and measure everything, because you never know what's going to be successful.
Yeah, I think the folks on the panel have already covered the metrics a lot. I'm just going to say one simple thing. In the teams that I see that are incredibly successful, it's their willingness to be open and learn, because what worked yesterday doesn't always work tomorrow. And so the guys, and this is, I'll give an example. We have an investment in a company called Coveo out in Quebec City, and the CEO is Louis Tatu. He's the guy who started Taleo. I mean, the guy's an incredibly, incredibly successful guy. And, this is his third startup. Taleo was sold for $1.6 billion after it went public. And he's spent the last, we'll call it 3 years as CEO in what was originally a perpetual license business, has transitioned it to SaaS, and he's now come to the conclusion that his entire go-to-market is broken, and he's changing it from scratch, whole thing. And he just went to the board, recently and basically said, this is going to be a bit of a shit show for the next 6 to 9 months. But he has the courage to do it and probably the credibility to do it. Yeah. But there are so many of us who sort of keep pounding our head against the wall thinking someday this will work, someday this will work. And the smart ones actually say, you know what, this just isn't working. I got to figure out what will, and they try something new. And that's really a big deal.
So should everybody here use hashtag Coveo when they tweet that out? Shit show? Hashtag shit show? Yeah.
That's a technical term.
I'm still learning, and business is fucking hard. Like, I don't know, it just takes a long time to build these businesses, much longer than I expected. It takes a lot more capital than I thought. A lot of the CEOs would wish they had their capital back and spend it differently, and it's almost across the board. It takes much longer to release products. I think that CEOs land up overbuilding or replatforming when they don't need to, and they should just iterate existing products. So there are a lot of, we rebuilt recently a product that took us 2 years. It was a year delayed. And we just looked at it at the end and said, I wish we'd just gone back and iterate the existing product that was selling and working well. So I'd say release faster, and be more efficient in terms of how you spend the capital. And then the last thing I think is culture is so important. And so when you're investing in companies, I mean, you'll go from 15 people to 60 people over a 2-year period. You have a completely different team. And the one thing I've seen CEOs learn is, or entrepreneurs or founders learn, is that the people that you thought were good may have been good for this level of company, but as you grow, you realize what good really is. And so, and that never stops. And don't be afraid to push your team as hard as you could, because they're CEOs that walk on eggshells around their team. And I think you should push your team as hard as you can. And it's a race to get out there. And it's I don't know, you should be driving in 4th or 5th gear all the time.
Guys, that's a great insight from all you guys. Thank you very much for that. I mean, lots of lessons learned there in terms of things to look out for. So that's great. Thank you. The next area that I wanted to touch on: valuation, dilution, cash runway. Does that matter to anyone here? So just to get a sense of some of these things. So for Daniel and Sandy, so at what point should a SaaS startup start thinking about raising institutional capital? When's the right time?
I think I think if you've already got capital, you're always raising from your existing partners, so you have to treat them really well. And I'll give you an example of that. And then you should always be raising money, but not let the world think that you're always raising money, because it's like dating, right? As soon as you need to raise the money, it's very hard to get the capital. So I would say you're always building that relationship, and you always want to give yourself time and options. I'd be raising capital when you don't need the capital, and make sure that you're, the best time to get capital is when you're close to break even, you get the highest valuation, and you're not running around or scrambling. And then in terms of your existing partners, I mean, we've done deals where you've got a whole bunch, they haven't wanted one investor in terms of too much capital from one investor, so they go to 7 or 8 investors and get a small amount from each investor. And the biggest issue with that is no one really cares about your business because you put in $200,000-300,000. The companies that have put in $2 to $4 or $5 million I'm paying attention to, and if we build a good partnership, I'm going to invest in more capital in the businesses over time, versus the companies that have thrown in $200,000 to it's literally been throwing in $200,000, and when they're running around looking for capital, they really don't have a partner at the table. So treat your investors really well, treat them like partners, and then I would say always look to raise capital when you don't need the money.
Wilson, I was going to say, when should a company start marketing? Or selling, or building product? Right. I mean, Always. This is something I've been on a tirade about, so I'm sorry for anybody who's been in front of me when I've been on this, but, fundraising is not an event, it's a function. It's something you do all the time. So I'm not saying that you should be spending 24 hours a day out meeting with investors, but I am saying that if 2 weeks have gone by and you haven't met with somebody who could at some point invest capital in your business, you're not doing your job. And I know that sounds ridiculous and self-serving maybe, but the truth is that, what Daniel just said is the most important thing, that I could say as well, which is, if you're going out to raise money when you need money and you're meeting that investor for the first time, you are not going to get the deal that you want, right? There is no way that if you walk into my office and say, I need $10 million in the next, 60 days, you are not going to get the deal you want. You probably won't get any deal at all from me, but you're definitely not going to get the deal that you want. So whereas if you've been, if we've been talking for 2 years, since long before you were even a business that I could fund, you told me what you were going to do, I watched you do it, where you were successful, you delivered on what you said you were going to do, where you failed, you've learned a ton of stuff, and you can come back to me and say, yeah, we tried that, it didn't work, but here's what we learned from it, and we adjusted, and here's where we went from there. I'm much more interested in having that kind of relationship with the people I'm investing in than in having the guy come in and be like, oh yeah, I need $10 million, and here's my amazing business. And it's not even necessarily that his business isn't amazing. It's that I can't understand his business enough in the 6 weeks that I have to analyze it to actually be able to make a good investment. So, yeah.
I think the other big mistake people make when they come to us for capital is they'll come and they'll meet with us and they'll say, we're going to sign Coca-Cola or Microsoft or whoever you're going to sign in the next few months. And you come back 6 months later and on that list is still Coca-Cola or Microsoft that you're going to close. And as investors, that's all we have. We look for consistency. So just be careful not to overpromise, and we look at that stuff closely.
So the next question in around this topic is, so what should for Matt and Alex, so what should a founder be considering when they're trying to decide how much to raise and at what valuation?
How much do you need would be a good place to start, and where are you on that sort of chart of a company? Like, have you proven out a real business model, or do you have some early traction? Right, sort of separates the men from the boys. I've always been a big fan of raising a little bit more than you need. The last company my own startup where we raised money, we didn't raise enough. I raised a seed round of $600,000. We probably needed $1 million. It would have served us better over the longer term period, but we were so valuation sensitive with me and my partners that we just wanted as little dilution as possible. And what came back to haunt us was, I was trying to raise money during the financial crisis, which is the worst time ever to have asked anybody for money because they were watching all their investments just hit the floor. And I remember sitting in an office in Boston with a VC, and he told me, Matt, we're probably not going to invest in anything for 3 months, so you're probably better off not coming in today. And he was our #1 prospect. And if we'd had 3 or 4 months or 6 more months of runway, we wouldn't have had to sell as early as we did. So I'm a big believer in not really worrying about what valuations you have in your head of ownership, because 100% of nothing is nothing. Right. Selling, getting the capital and not keeping it as close to the break-even point of what your plan is going to be is probably the best move.
Okay, thank you.
So I tend to try to look at the next round and work backwards. In other words, what are you going to need on a Series B? What do you think the valuation expectation should be on a B? And where can we land on the A? Because what genuinely happens is people try to optimize their valuation because they want to minimize their dilution, which I totally understand as an investor and am obviously sensitive to. But what ultimately happens is you overcommit the Series A, you underdilute yourself, and then you fall into prey in the Series B where someone's staring at a business that's supposed to have $20 to $25 million off the Series A and has $1.5 million to $2 million in revenue, and you're saying like, I'm going to do 5 next year, and the investor's saying, okay, you're going to do 5 next year. What's that going to mean for your valuation? Like, this looks like a flat round to me. So, that problem could have been avoided. You would have found a whole other spectrum of investors had you not closed a post of 20 on your Series A, but rather closed a post of 10, 12, 14, or whatever it is. Part of the other problem that exists is that we now see co-founder groups of 3, 4, 5 people, all with equal ownership. And so that ownership isn't great to begin with. It's not like back in the day when you had one founder who had 80% of the company and kept the other 24 the employees before the seed or Series A. And so when you have like 3 or 4 co-founders, it makes it difficult to make that decision because you're really dilution sensitive. Because now you're staring at, you've gone from 20, you take a 25% hit on the investment, and now you're down to 15. And now, there is a real meaningful impact that has on the exit.
I just wanted to add one thing. So I kind of go the same way you do, Matt. There's no such thing as dilution, right? But beyond that, I would say, so many people are so focused on dilution, and they're so focused on what that headline value is, and they ignore terms. And that is just a killer. It will kill your team, it will kill your business, it will kill everything if the terms that you get result in either, A, what Alex was talking about, you struggle to raise your next round because of where it was priced, but B, you end up in a position where you've got a stack with 5 levels on top of each other, and everybody's got different incentives, and nobody is aligned with management. Everybody's chasing a different end game. It's a nightmare. So to me, spend a lot more time trying to make sure that the terms you have make sure that everybody around the table is aligned and focused on the same end game, and less time on the valuation, because then you'll actually get to the end game that you wanted.
So I just want to add from from an operator perspective, I was at a company, this was back in the .com days, so again, I'm dating myself here a little bit, but it was a feeding frenzy in terms of, people were doing business plans on the back of napkins and stuff and raising all sorts of crazy valuations and dollars, right? And one CFO that I met, he was a CFO of a company called BeFree, and they raised a $100 million round. And he said to me, he goes, when they're serving, hors d'oeuvres at the party, and if they're going to keep walking around and serving the hors d'oeuvres, I'm going to keep taking the hors d'oeuvres, right? So as long as the money's there, I'm going to take it, because you know what? No company ever went bankrupt from too much dilution, right? No company's ever gone bankrupt from too much dilution, but in the opposite, if you don't get the capital, you can't fund to build your business, right? So trying to optimize to get that extra, X percent, minimization and dilution. Sometimes you can just do something a little bit too fine, and it holds you back, right? Having the oxygen and the fuel to kind of build your business is the most critical thing. It's not going to be a one-round investment. You're going to have multiple rounds, right? So you need a good investor, a good partner that is going to be there and supportive of you in good times and bad times, and is going to help you, because it's not always going to go like this, up and to the right in a straight kind of curve. It's not going to be that. It's going to be a roller coaster. You're going to have some ups and downs, and you just want to make sure that you're personally aligned with the investors, and you kind of have a good fit with them, because you're in for, it's a partnership, right? You're in it for the long haul with these guys, right? And so they're your new business partners, and it's important that there's a good fit from that. So I think on the next, so we're done kind of the formal piece here. So what I'd like to do is open it up to the crowd. I'm sure you guys have some questions you might want to ask the panel. So with that, is there any questions that you guys want to, we'll get the mics out to you. There's a question there. Is anyone, okay, let me get that. I'm going to start with you since you're closer, and we'll get another mic out back there.
So to any of you guys, just wondering, do you think from the company's perspective, it's better to partner with a VC who can do multiple financing rounds and actually have that as a prerequisite so that you're not chasing new partners all the time, or does that really matter at all?
I think it matters a lot. And it's self-serving, because we're a fund that generally thinks about 2, 3, or 4 rounds into our companies as we go through the lifespan of a corporation. So we're a full-stage investor. There's very few investors that I know of that don't do those, except for angels. And in Ontario, the Investment Accelerator Fund as well, they don't do follow-on. So that can make room in your later rounds for another VC to come in and get a good chunk of the company if they need to. But from a purely self-serving statement, I think it's great to have a VC at the table that'll go all the way with you. Well, take my case in point. So I've done 2 companies where one where I was the founder and I raised my seed round, and then we did not have a VC that could go all the way with us, and then we had I raised the seed and Series A for another company that I didn't found, but I was the director of finance there. That company is a company called GAN Systems. It's in Ottawa, and it's growing quite quickly, and one of the greatest things is for them today is that they have VCs that can go all the way. So when they decided, hey, we should probably raise another round, their VCs were able to bridge into the next round. So they had money at the table. So there was no slowdown in growth while they tried to raise with find a new VC as a lead. They were just able to keep on moving as they were, and so that was very helpful.
I'm going to answer it a different way, Mark. I think it's delusional to expect that will be true. There will be people who stand up here and arguably, we play much later, so we don't really do, from the beginning to the end. But I think The reality is you should always be out fundraising. You should always be out meeting new investors, even if you have investors that theoretically can follow on through till this, to the point where you never have to go public, which is what people will tell you. They can continue to invest and you never have to go public. You can just be a private company forever and distribute cash if you want to. I just think, you're taking too much risk, right? With putting all your eggs in one basket. So from my perspective, I would always have people that you can go to for the next round beyond your current investors. It also, your current investors, it doesn't behoove them to set the next round at the highest valuation possible, right? If there's no competition there, there's no reason for them to do that. So it's always good to have other people at the table.
I'm just going to give you a story that just happened. So we invested in a company recently that's performed really well. And first of all, any investor, if a company's performing well, is going to put more money into your company, right? And any investor will sit there and tell you that they're going to support you until you're not doing well, and they won't support you. But it's the truth. And so, but we were sitting there with the company, and we committed an additional, call it $2 million to the business. So we made the investment 7 months ago. The company's grown threefold since then. And they came to us and they need more capital, right? And we said, okay, we will finance you at this level. And I think let's call it valuation of $10 million. But we said, we will support that valuation. You go out there and see what valuation you can get that's higher, and we'll participate in that round, right? So they did, and they got a valuation, let's call it $15 million. Actually, we introduced them to a bunch of VCs, and they got the valuation of $15 million. We landed up being a third of that round, right? So I think if you could find partners like that, I mean, to me, that's a great story because we supported him, we gave him a backstop. He wasn't worrying about running his business. And he had 2 weeks left of cash flow about a month ago, and he's closing the round at the end of December. So we actually funded him our capital 2 weeks ago. And so I don't know, find partners like that, right? In my mind, that was a really, really good story. And you know what? Even though we didn't get the best valuation for us, we got someone that we partnered. We were true partners, and they will talk nicely about us forever.
Back there. Oh, there's a question there.
Hi, my name is Paul Philp. I run a company that helps SaaS companies increase their prices and sell into their existing customer base. So if you want to impress Sandy, you should talk to me. You've talked a lot about distribution channels for SaaS companies. What's exciting and interesting and new in that area, and what's going to happen over the next 3 years?
I know, I'm not sure how this happened. Anyway.
I can talk about one of my portfolio companies if you want, if anyone's interested in hearing. I mean, we invested in a company just down the street from here called Influitive. We seed financed the company. We led the Series A. Company has grown, basically 3x this year already on their monthly recurring revenue. We've got close to 50 employees there. Just talking about the growth, but you're asking what's next. So they're positioning themselves as the advocacy marketing specialists. And the way that the company works is if you're a B2B marketer, you want to leverage your existing customers as referrals. You want to leverage your existing customers to write case studies for you, to participate in panels for you, to do all the things that your advocates do. This platform manages that. It identifies who the best prospects to do that for you are, and then rewards them on the back end for completing the tasks that you've asked them to complete. So I think that that's something, look, there's a lot of money being poured into SEO and SEM today. There's a lot of money being poured into trade shows today by B2B SaaS companies. We see that migrating to this model, and I think proof is in the pudding. I mean, the company has, I want to say, about 140 clients or 150 customers right now. We were sitting somewhere close to, I don't know, maybe 30 or 40 at the beginning of the year. So that's the sort of thing, that's where I think the market is heading, which is find your army of advocates, hire them or task them to do certain things for you, and you'll reap the benefits and the results, not only from the tasks at hand, but also through the social media traction that you're going to get, and again, how that's going to prop you up in SEO and SEM in ways that you before would not have thought of. You got an answer?
Yeah, I wish I had a great answer for you. I think the only thing I would say is, you know, SEO and SEM are the standards and everybody's using that stuff. I actually, contrary to some people's belief, do believe social will come around even in B2B and will be valuable to people. I will tell you that, you know, 6 years ago when I was running sales and marketing for a startup, you know, B2B startup in New York, we tried LinkedIn ads and it was the most enormous waste of time I've ever seen in my life. But I do think that stuff will, in the next 5 years, be meaningful even in the B2B space. I think the opportunity for someone like LinkedIn to do retargeting of, I mean, to add them into your marketing automation funnel with retargeting of people who have specific backgrounds and characteristics is pretty compelling if they can totally pull it off. So hopefully they'll get there.
So I think we're seeing the slow death of retargeting. I'm not sure if everybody understands that, but retargeting for advertising has been the sort of the brute force method for people to get people to sign up. I think Shopify's a very good offender of that, where if you visit their website, they'll drop a cookie, and 3 days later, every advertisement you see on the web will be a Shopify ad, for example, to try and convince you to sign up. I think retargeting is just expensive, and it's going the way of the dodo. Going back to, I've got numerous examples now of LinkedIn ads advertising working with a really proper content marketing strategy. So we don't see direct funnel landings, but we do see a lot of people interacting with content and then from there getting into the funnel of the sale. So, you know, I don't think we'll see any one channel force through customers, but I think if you can bring them to water, they might drink sort of mentality. I think that's what we'll see over the next little while.
It seems to be the key thing for valuations, at least the perception, and companies don't necessarily focus in on churn or multi-year contracts as key metrics from a valuation perspective. Is that skewing behavior in terms of not doing the right thing for the company versus and commentary in terms of how you actually value it?
So I think multi-year contracts are meaningless, okay? Because you can get out, there is no question in my mind that if you sign a multi-year contract with someone and you want to get out in month 3 or month 4, you're just going to either stop payment and cancel that subscription, and if they don't oblige and they hold you to your 2-year contract, you're going to blast the hell out of them on social media, which is going to be to everybody's detriment in the company. So I put absolutely zero credibility in long-term contracts. And in fact, to that end, I put very limited at a Series A stage. I put very limited credibility into the long-term value of a customer because it's just almost impossible to calculate. Like, business is 2 years old or a year and a half old, and you're telling me that this customer is going to last 4 to 5 years. Like, there's no history there, right? It's impossible. I think top line growth today, absolutely. If you're in California and you're talking about a SaaS company and valuations, on the West Coast, 100% it is top line growth. 100% it is about momentum. There's absolutely no question in my mind. If you are on the East Coast, it is a very, very, very different conversation. It's about efficiency of capital at the same time of growth. But I think that it depends very much on who you're talking to and what their perspective is at that time and the other companies that they're seeing around them.
No, that's perfect.
What are some red flags that will deter you from investing in a company that seems to be doing well on the surface?
People who wear black shirts.
Should have worn the pink shirt.
Founders stepping on each other in a meeting is pretty blatant. I'm not sure how many times I've seen founders disagree with each other on the fundamentals of their own business in a conversation with me. When I start asking probing questions, you know, in the very early stages, you're essentially dealing with a team and an idea. So you have to be very, you know, sort of cognizant of the fact that, you know, you're going to get into bed with these guys. You have to work with them, and if you like them, great. If you don't, probably not a good deal for you.
Sure. I think for me it's values, and so when I meet someone that I connect with, and if I don't connect with them, and someone that I think I can work with, because we're going to be together for a long time, right? It could be 8, 10, 13 years. So as long as our interests are aligned and we have that personal connection. If we don't, I don't care how well the business is doing. It's just not for us. I have enough businesses already. We have 14 companies. The last thing I need is someone I don't get along with. And at least for me personally, I just hate confrontation. I just like getting along with my partners.
So doubling down on Daniel, I can't handle arrogance. I can't at all. I mean, most of these businesses are early. They don't have it figured out yet. They've got a few things that are working, and to come in and sort of make the assumption that you know all the answers to all the questions and that there's no uncertainty is just, it's just a bad foot to start on, right? So I think, you know, people are asking you questions not just because they want to know if you have the answer. They're asking you questions because they want to know how you're going to answer and whether you're, you know, too sure about the future. And to me, that's the flag. And I've done stuff where we've gone into businesses and, in theory, you know, serial entrepreneur, huge home run exits, amazing story, and the guy is the most arrogant prick I've ever met in my life. And I'm just like, look, I just don't want to sit in the same room with that guy. I'm just not going to do that. It's not worth it.
By the way, we don't know answers to most of the questions that we're going to get either. So there's a pretty good myth debunked for you. Like, look, we've got reference points. We've got other portfolio companies. We have history in the business. We've seen changes like everybody else. But like at the end of the day, you know, all we have are places to guide you to and perhaps answers. VC's on the Midas list. They've had home runs, and guess what? They've also had strikeouts. Like, everybody has had them. And so it goes back to what everyone here has said, that this is about building a relationship. It's about getting to know someone over the long term. It's about being able to go out for dinner or have coffee with them or bring them to your house for to meet your family. It's not necessarily about just having a business relationship with them. I don't think that that's what any of us would even want out of a financial relationship.
I'm just going to add one more comment to it. I mean, I find that too many people, there are many times when people come to us and all they talk about is who's investing in this round and what the company's going to be worth one day. And I don't care what the company's going to be worth one day and who's investing in the round, instead of talking about how they're going to build a great business. And so that's all I want to have the conversation about. And many people fall into that trap.
What about a subsequent round with structure of the company? So let's say the company's too diluted and you just could be a great company, but you're like, let's invest. Something along the lines of that.
Well, there are lots of opportunities where we just can't get enough ownership to make it worth our while to invest. That's a function of where a company is in their life cycle.
Just looking at examples like that.
So just on looking at this another way. So if the company, let's just say the valuation on the last round was too high. Company's looking to raise $10 million, but we can't get there on value, and we can get there on ownership, but on our terms and not yours, and it might crush the cap table a little bit. Like, I would avoid that at all costs, because I wouldn't want to get into a situation with a founder, with an investment team, where I'm doing something to them that's really going to negatively impact everybody, and you might be able to find a better partner who can propel your valuation to a point that's going to make everybody happy.
Yeah, let's say the same thing. I mean, when you get to that point, where you're 7 rounds. I mean, all of the deals that I look at in our portfolio where there's 5 or 6 or 7 rounds into the company, like, those are some of the most challenging situations we have, even if the company's doing well. Because there's just so much misalignment amongst the investor base, because it's all coming at different times. They all have different priorities. They're all in different funds. Some of them are on their 5 funds later, and they just don't care about this anymore. Or they really care about it because it's the one thing they committed to their LPs is going to deliver, and now we're going to crush the stack. And so those are really hard situations. It's why you spend so much time focused on terms and not valuation.
I think there's a time and place for angels in every deal, because companies need the capital. They haven't reached a stage where they can get a investment from a institutional investor. And institutions are moving more and more upstream. Even the guys now that are doing seed rounds that have $40, $50 million funds want to see a certain amount of traction. So there's always room for angels, and I think we've got some amazing angels in our portfolio companies. I mean, we have in Nulogy, we've got Art Mesher, who is the ex-CEO of Descartes. In all our companies, we have angels that have real experience and often sit on the boards and add a lot of value. I think you just have to be careful who you're taking money from, And having said that, there's another situation where I know the angels that require dividends. I mean, that's really restricting the company from growing. So you just have to be careful which angels you take. But I'm a big fan of angels with the right experience being partners with us.
We've co-invested with numerous angels all across Canada, many CEOs of successful startups, including some of our portfolio companies that have exited over the years. So we invest right alongside them. So we haven't had any issues with them. In the later stages, we probably around the B round, we sort of look to put them into a trust of some sort, just to protect their interests and to make administration of the company a little bit easier. But beyond that, no particular issues.
Make sure they have a long-term view. That's all.
Okay, I just wanted to thank the investors, each of them, for the investor panel. It was very informative, and thank you very much.
So good morning, everyone. I was opting this morning. For someone who doesn't like to wear a tie, I look for every opportunity where I don't have to, and I'm glad I have the solidarity of the people in the room here to not have chosen to wear one today. My name is Randy Blackwood. I'm the Vice President of Financing and Consulting for Toronto Central and Eastern areas, and it's my pleasure to just quickly address you. I'm in the precarious position of being between you and the bathroom and a break, so I'll keep my remarks short, but I just wanted to thank everyone for coming. And as well, just highlight, obviously, BDC is committed to entrepreneurs in Canada. That's what we do. We have term financing solutions. We have advisory solutions for entrepreneurs. And as we upstream, we get into growth and transition capital, which many of you are familiar with, and venture capital, which we're one of the largest players in Canada in that segment. So we're very pleased to be supporting Canadian entrepreneurs. We're always trying to find ways to justify what we do, to recognize the growth and the improvement in entrepreneurs in Canada. And one of the terms we bandy around quite a bit is impact. How do we have impact with entrepreneurs in Canada? And I'll just take just a quick moment to let you know some of the ways that we're looking at it, especially as it relates to the industry and tech industry as a whole. One of them is the number of clients that we're servicing. And in the tech industry, specifically in Toronto, this is a market that's continually growing for us. So not only are people looking for term financing solutions, growth and transition capital and beyond, but we're actually finding those people and we're finding those solutions for them, and we're very proud of that. The other one that we look at is the graduation rate of our clients. And we do a lot of very small lending solutions with easy covenants, as it was mentioned earlier here. And we're proud of that because we understand we don't want companies to be bogged down with trying to manage their financial statements monthly. We want them to focus on growing their business. As those companies grow, they come from smaller levels of debt, maybe a little bit more medium level, into growth and transition capital, and then on and beyond that. And we monitor that, and we're very proud to say that we have many clients who are moving up the ladder, and that makes us very proud. The last one, obviously, are events just like this, bringing people together from the community, banding about ideas, having experts, as you've just heard, talk about how we can do the job better, how we can continue to grow and provide an environment and a forum where people can get together. And that doesn't come together just with us, though. And so you notice we have a number of banners around the room of sponsors who have also here today. And these are also organizations that are focused on growing entrepreneurs. So we've got a pretty exciting room here, people who are looking to grow the tech industry in Canada and specifically here in Toronto. So I'll leave it at that. I'll just say again to Denicia and the team here that have put this together today, it's a fantastic opportunity. And we're going into a break, and that's where a lot of the action happens as well. So you guys have a chance to network with one another. So thank you very much.
Okay, so I think we're going to kick off the next panel here. So, you know, we have, and the panel just before we heard about equity investing and all sorts of things and insights in terms of what you should be thinking about for equity investing. This next panel is all about alternative sources of financing and non-equity, I would say, and therefore non-dilutive. So very, very important to each of you as owners and entrepreneurs. So thank you, panelists, for attending this session and for the insight that I'm sure the group is going to get. And again, to kick it off, maybe what I thought I would do is have each of you Describe your firm, your fund, kind of where you guys are in terms of your stage of investments and whatnot, and just give people a general overview of what you guys do. So there's a mic there that maybe we can pass around.
Perfect. Al-Karim Jabraj from Espresso Capital.
Yeah. You just have to hold it close, though.
Okay. We are a provider of mostly subordinated debt or senior debt in some cases, working capital and growth capital solutions. Taking the form of two specific product lines. We do tax credit financing and recurring revenue financing for companies with a recurring revenue business model, SaaS companies notably. Our mantra is fast, fairly priced, and user-friendly risk capital. Our typical deal funds in 10 days. We've got over 100 portfolio companies, and we're all about how do you make capital easy to access and easy to consume.
Good morning, or afternoon, I guess it is now. My name is Michelle Cooper. I'm the branch manager for BDC in our Mississauga office. And today I'm going to talk to you about one side of the bank a little bit more. My counterpart was here talking about VC, but I'm going to talk to senior debt from the standpoint of early stage, from a startup and early stage to beyond. Companies we do, again, working capital, growth financing, up to about $500,000, and then we also have a team, growth and transition financing team, which I'll speak a little bit on as well, and they would work with us in terms of $500,000 up to $30 million. So they're across the board with, I would say, average deal size probably in the $1 to $3 million range.
Good afternoon. Eric LeBlanc, manage the RBC's technology banking group, and we've been in the marketplace for 20 years now, and clients that we serve are enterprise clients, technology-enabled services companies, e-commerce, mobile, among others. Our emphasis is on, because we are technology-centric, is a focus from a startup to much larger. So our credit will run from the 50,000 to 50 million range, and again we will segment that as the companies grow. And that's a bit of an overview of the market.
Thank you very much. So the next question is, so what's the criteria that you guys look at for financing? Companies, and what's the kind of the general deal structure and terms that you guys have, and how much? And you mentioned time for yourself in terms of how quickly you do deals, but just general time frames that an entrepreneur can expect from starting to finishing to kind of get through the process. So it's for open to all of you. So you got the mic. You want to start, or?
Yeah, sure. I've got the mic. So. That will vary, but I would say that, once we're in a position of having all the information that's required, you're looking at a kind of a 10-day turnaround to kind of understand, is there a transaction there to be had or not? That's going to vary as well, whether it's an existing client, someone we know well, or someone we're starting out from a starting position. I think many of the panels before talked about getting to build relationships and build relationships early. So, from our perspective, the ability to work with startups as they're starting out and get to know the management teams, understand the plans that they put forward and they executed on, obviously allow us to make quicker decisions down the road and execute more quickly. Again, you build that relationship with someone that you trust, and it certainly enables growth from that perspective. I'll just kind of hand over quickly.
Sure. So what I like to say is a lot of tech companies think there's no debt financing out there, and part of our role is here to tell you that actually there is. And we do a lot in this small side. In our Toronto office, we would do a couple hundred deals a year. So if you start thinking of where we are versus our VC group and even our growth and transition group in the middle, we're definitely more of a volume shop. It doesn't mean we're not looking at the deal. It has to make sense. We do apply credit judgment the same as any bank would. And we partner a lot with banks. So often a client will come to us in a startup or an early stage to see if we can lend. What I do is I would look at an investment into a company, a term loan, where you would pay me back principal and interest every month. So it's not equity, it's debt. There's no tangible security, so it is a personal guarantee. And my criteria, if it's, usually we want to see, we'll do startup, I kind of like to say start it up, where we have a good sense that there's some level of revenue, may only be a few months, but we really spend a lot of time making sure there's market acceptance. And we really want to make sure we don't fund too early because, again, once you start paying, you have to pay us every month. So I don't want to fund until I'm comfortable that you'll be able to repay us. So we start looking at the financials, really around that market acceptance, the business plan, do we understand it? We look at the personal side, and this is probably the biggest difference on kind of, if you look at BDC, you'll have what I will call senior debt that's unsecured versus our growth and transition financing. We kind of look at it almost like it's an infant growing to a toddler to a child, almost as the business grows up. So once the business can stand on its own and be looked at on its own, then we often say it's ready to be in our growth and transition financing group. And usually the ask is more than $500,000 at that stage, or maybe it's $250 now with another round in 6-12 months. And that's where they would get involved early if they think they're going to lend again in a short period of time. But if the company is not at the point where the cash flow is strong there, that we're comfortable maybe lending at that stage yet, our side can lend, but we're going to look at the personal situation as much as we are on the commercial side. So what I would say to people is make sure your personal side is in order. We're looking at, often what we see is companies come to us, they've been in either startup or early stage, they've been mixing both their personal and their commercial money together. It's all one big pot of money. Try and separate that as quickly as you can, because that's some of the early criteria for us.
So maybe just a quick follow-up question on that one, Michelle, if that's okay, right? So because I think there's a lot of people in the audience who are kind of at that early kind of, market acceptance phase, right? So for them, getting customer traction, a couple of first customer wins and demonstration of revenue, and albeit early and small, that's one of the key criteria that you would need, right?
Absolutely.
Okay.
I mean, again, there's no right or wrong. The panel this morning, and there was a lot of talk around metrics and things like that. We will look at it to a certain degree, but we really want to sit down and have a good understanding of the business model. Where's the revenue coming on a monthly basis? Where are your expenses? What's flexible, what's not? Oftentimes, we'll get a company come to us and we'll look and the expenses are really high, but we get a good understanding of what can be cut if need be and things like that. So we really just try to take it by case and see where we can go from there. One of the main criteria for dealing with us is that you need a charter bank in most cases. So this is a great way that we often partner with RBC, because they are one that lends directly in the tech space, so they understand the business model and that. So we'll bring them in often very early on to say, it doesn't mean we can't lend without a charter bank, because a lot of startups won't necessarily have that support day one, but it's oftentimes we'll lend, and then a year or 2 years, that's where maybe if you weren't getting an operating line right away, that partnership comes in.
Great, thank you.
Terrific. So there's a handout with books that has most of our lending criteria, so you can take those away. But in summary, we're funding companies from raw startups when we're financing their tax credits. We will occasionally do first-time filers, and we go all the way to companies that are cash flow positive. $20 million is the biggest company that we funded in terms of the funding size, as little as 100,000, as much as 4 million. It's all in a credit facility, so you can draw down money as you need it and pay it down when you don't. So you're not paying interest unnecessarily. There are no big prepayment penalties. So we try and make things simple. And then in terms of qualification criteria across our two products, with the tax credit financing, it's pretty simple. We've got to have comfort that your R&D work is eligible for the tax credit program that you're applying for. Or in the case of the government grants, you've done the necessary work to receive the grants. We will also do fund against FedDev receivables. So that's one bucket, making sure the eligibility is right. and you've got the audit support in the event that you get audited. And then on the recurring revenue financing side, we'll come in as low as $100,000 a month in recurring revenues. That is a growth facility which can go as much as 6 times the monthly recurring revenue number. So if your revenue is $100,000 a month, you could get a credit facility up to $600,000. On that, we're looking at your SaaS unit metrics, which you probably talked about this morning. So, you've got to have decent margins. You've got to have customer acquisition costs that are reasonable and trending in the right direction. You've got to have churn that's, improving. So all the usual things. We take a pretty pragmatic view of your business. We appreciate that, perfection doesn't happen when you start up. It's something that you work towards, and you probably never achieve it. But we're in the business of taking risk. We're mezzanine, so if there's scope for you to put on cheaper capital from the bank and the BDC, we encourage it, and often we'll let them rank ahead of us, always in the case of the bank. And I would say that probably half our portfolio, I bet, are shared with the bank and the BDC. So, we appreciate that you've got to be able to play ball with the other lenders in the capital table.
On the personal guarantees, my understanding is that it's a non-secured personal guarantee?
It is. So the personal guarantees, that's probably one of the areas I often meet companies, or I'll meet a partner and they'll say, oh, they're not interested in talking to you if you talk a personal guarantee. So what we do is it's a non-collateralized guarantee. We are not allowed to take personal assets as security. But I call it a document. You and I agree if anything should happen to the company, we're going to come and ask you to pay us back. And we fully will enforce on that guarantee. But in the meantime, your assets are free and clear. You can do what you want with your house and everything else. So it's a commitment. We're looking for people that are committed to the business. As I was saying a little bit, kind of the infant to toddler growing up of the business, once the business can stand more on its own, that's where the personal side starts to take on less of an importance. And so when you're going in growth and transition, oftentimes they wouldn't be taking a personal guarantee.
And Al Krim, so just on your products there, so when you talked about the tax credit financing and about first-time filers, and so when you as a company file your SR&ED return and you're entitled to a refund and you don't want to wait 6 months or a year to kind of turn that into cash, that's where that product comes in. But then when you have a customer that's got a bit of a history with you, can you talk a little bit about your accrued SR&ED program as well? For sure.
So the way your spending on R&D happens is you're spending every month on salaries and whatever else, rent, and then you would probably, in a normal case, after year end, maybe 3 months after year end, file your tax returns, and then somewhere 3 to 6 months after that, the refund arrives. So by the time from the date you started spending the first dollar to the refund, that's a year and 3/4 has elapsed. And so with our tax credit financing, and we'll do this out of the gate with first-time filers if we're comfortable around the eligibility and audit risk, we'll let you borrow on a quarterly basis up to 80% of the accrued future refund. And so this really helps free up capital for particularly early stage companies where you've got to hit milestones, and when you achieve the milestone, you can get the next batch of money, whether it's equity or whatever. And so the tax credit financing is truly a bridging solution to help you hit the milestone so you can free up more capital.
That's great.
So I'll just follow back around the kind of descriptions around structure and so forth. Certainly from our group at RBC, as everyone's pointed out, we love to partner with the individuals here on the panel and others. The type of financing products we deliver, provide beyond, your all-day, everyday banking accounts and so forth are, we do SR&ED loans, complementary, I think, with Al Karim. Rarely do we fight over, is it us or is it them or someone else? Usually there's a demarcation there and we can find that space. We do operating facilities. We will, try and mitigate risk for clients as well through foreign exchange and different operating services. From a structure perspective around SaaS lines, where we're looking at, while we do you deal with startups? I think if you think back about the metrics around client diversification, churn rate, and all those other key metrics, it probably equates out that until the client company kind of has a couple $1 million of revenue, it's going to be difficult for a senior lender to kind of get the metrics you kind of need and the understanding of the business to kind of do a SaaS line. So I would say kind of 2 million revenue annual and growing is kind of where we get involved on that perspective.
And what kind of multiple would you provide at that point? And let's say they were doing a
right.
I don't know, right?
Yeah. So and it would be based. These would be based on a multiple of MMRR. Yeah. And typically anywhere from 2 and up. From again, depending on the individual circumstance and other factors in there. From a security perspective, won't say we never take a personal guarantee or personal covenant. We try in most cases not to do that. We are really trying to look at it from a business plan perspective, understand the company, understand its clients, understand the risk involved and the cash flow. And we do try and do it based on corporate security only, as much as possible.
And so when should for all the entrepreneurs out there, when should they consider, the alternative form of financing versus equity? Like what advice would you give them there when they're considering both?
I'll certainly start out, and I would say, and I think it resonates to what the previous panel was saying. I think that reality is, and it's easy for me to say at this end versus, sitting in the entrepreneur's chair, but I think it's both. I think that approaching both, a senior debt lender and an equity investor at the same time makes sense. Now, there are issues around diluting the company's ownership and all of those type of things, but I think you can de-risk the growth by having both equity and senior debt in the company. I think it allows everyone to grow and maximize the growth of the company.
Okay.
Yeah, I think some of the equity versus debt debate's a bit of a red herring. 2 things. First of all, any money that you have to pay back, preferred shares, which is the most common form of equity investment in technology companies, is essentially debt, because you've got to pay it back in 5 years and 7 years, and if you don't pay it back, they have right to sell your business. It's no different than a bank loan. So debt and equity is not so black and white. I think the trick is to look at the features around it. Royalty loans, which you talked about this morning, in my opinion, are absolutely debt, because you're servicing them every month with the interest payments. They're secured, and so I think when you look at these things, you need to make sure that you look at the characteristics, the risk profile to the lender, the risk profile to you if you default, and figure out where this fits in. The other thing is, in the context of Canada, and in the US, in fact, less than 5% of all technology companies are institutionally funded by venture capitalists. So the other 95% of the ecosystem needs to bootstrap their funds any which way. And so the bank, the sub-debt lenders, the angels, I mean, for the vast majority of the tech ecosystem, they get their money every which way. And so, I suggest, being more open-minded and certainly more analytical around these solutions and in assessing if they're right for you.
I'm just going to echo those comments. It's something we talk a lot about internally. First off, talk to us early, whether you need money or not. It's never too early to come and start a relationship. The panel talked about that. Getting to know you, seeing how you execute on your plan, building that relationship is important for us as lenders. But I would also say at BDC, kind of our outlook, I don't look at it as we're a bank. My role is here to know who's in my market, who are the entrepreneurs, what are they doing, and how can I help them. So just as much our role is to be an educator and to bring different parties together, introducing one client to another client, introducing them to banks and saying, hey, have you met with these people? Are you doing shred financing or not? Every day we meet entrepreneurs, and a lot of them haven't been introduced to the ecosystem, which I find is actually very organized and structured in downtown Toronto. It's a great support system. We don't see this in a lot of other industries at all. So we want to build on this, and we really take our role as, come and see us, and maybe we'll give you some money, and maybe we'll do some consulting advisory services with you. Maybe we won't. Maybe we just have a relationship where we're bringing our partners to the table so that, we can add value to you.
That's great. So I think what I'd like to do now is open it up to the audience for. Sorry, did you have something to add to there?
I'm good.
So do we have a mic ready? Do we have questions for the panel on this form of alternative financing and debt financing? We have one right there. The mic's.
Thank you. So the dilemma with a lot of SaaS companies are we don't have a lot of assets. Our assets are people and our IP. And I'm interested as somebody that bootstrapped the company and now trying to raise debt financing. What is that crossover line for a business that you don't look at the personal assets and the personal guarantee and move? I won't mention who our bank is, but even getting a credit line or even a credit card without having me sign papers and show them my tax forms and stuff. And we maybe have over 5 million in revenue basically on an annual basis. So I find it kind of interesting that that this is being discussed, that the security is not, the personal guarantee for founders are not involved, but it is involved. So I'm curious to know at what stage we're going to move into the company sort of securities rather than the personal guarantees.
Sure. I'm going to take a stab and then hand it over to you guys. It goes directly to the amount of risk the lender is willing to take. And, that's also reflected in the rates that the lender is charging. So in our case, our view is if we have to take a personal guarantee, then we shouldn't be lending you money because you're not, you fall outside of our risk zone. So in our business, we don't. But if you're a senior lender like the bank, maybe the perspective is different.
Yeah. So I'm probably the only one who can answer the question around the Visa cards or the corporate cards. So I guess I'm on the spot. The reality is we have lots of earlier stage companies that have exactly that, corporate Visa cards that are secured by the assets of the company. They may not be profitable, but if we can understand the business plan and make sense. So I'm not saying we're going to give $500,000 corporate Visa card to a company based on the business plan, but something that allows them to manage the office, have a key salesperson, have a card. We can get our heads around that most of the time, especially if you're talking about $5 million of sales or $3 million or $2 million. As I said, we're starting from the premise that we want to do it without personal guarantees as we get into the relationship. So, if it was an RBC case, you're maybe not talking to our group, so happy to chat.
And it's interesting to that point. Talk to your banker and make sure you're dealing with someone that understands your business and where you're going, because that's probably the biggest thing we see is that a lot of people, until you're big enough, maybe they don't have a commercial line or they're not in a group, which is why I love RBC's KBI group so much, because they'll deal with all companies from the startup phase and really understand what your business is and the metrics behind it. From our standpoint, we always subordinate to the banks because we want you to have a line. So I never have inventory and receivables as security. And the only thing you could really give me as tangible security is either a building, which we never really see with tech companies, or equipment. So oftentimes there is no tangible security. So when would that warrant not having a personal guarantee is when the company is cash flow, like strong cash flow positive, has a couple of years behind them. We really can understand, and that's usually into our growth and transition group where you're looking at lending, say, $300,000-400,000 plus. Does that help?
Great. So, any other questions? Okay. I don't know what you want.
So my question is for the banker dude again, and that is, so when you've got a line of credit that's secured against assets like cash and whatever after a raise, and you want to get your bankers to switch over to lending you against your MRR because you have no receivables generally, how do you, like, what's the magic words trigger that will get them to bite?
There's a secret handshake for that.
Yeah, so that's a great question, because you're right. I mean, if you dig back down into deep accounting, maybe it is a receivable, maybe it's not. And it's going to depend, again, on your revenue model. Are you pre-collecting, or how you're doing that? I think it's about, we're going to fall back and look back at, again, how many clients do you have? What's the sustainability of those? What's the churn rate? Is it ramping up? Is it going in the proper direction? I'll be quite candid, right? We're not, if a company's massively cash flow negative, and I'm not going to talk about EBITDA or anything like that, but if the company's not somewhere around a cash neutral, and we could debate what that means, cash neutral, but somewhere around that, it's going to be more difficult for us, right? So we have to have some visibility around cash neutrality. If it's not, I think it's, it is maybe more, whether you call it equity or higher rate, like we're just not going to charge somebody, 20% for the money. There are lenders that will do that, but we're not a 20% lender, so.
So I imagine that many of our institutional banks that we deal with as new companies, SaaS companies, I don't think our bank managers know what SaaS stands for.
I agree with you 100%. Absolutely.
So trying to get them to lend against MRR is like a torturous education. Do we go to corporate? Is there a different, do each of these charter banks actually have a group that understands, SaaS, or do we just try to educate our...
Or just go to the RBC?
Right. So, I certainly can't speak for others. I can only speak for RBC, both here in Toronto, in larger centers across the country, Montreal, Vancouver. So I've got 11 account managers on the team. We've got a risk management team that we partner with. All of them understand what, SaaS is. Versus trying to define it. They understand the metrics that we were talking about and can have a conversation. Does it mean we're going to get to the answer that the client is always looking for? Not necessarily, but we understand it. If they can't answer the question or can't have an intelligent conversation with you about your SaaS product, then probably it's time to talk to someone who can, right? I guess. Well, I'll start with myself, and then you can fill in from there.
So we just have time for one more question. Oh, sorry. Michelle, did you?
No, I would just echo it from our standpoint, because we don't do operating lines. But come and see us, talk to somebody in our group, because don't hesitate. The big thing is you're not alone. Come out, reach out. Like I say, the ecosystem's really well developed, so pull on somebody who can introduce you to somebody. When I look around at, when I came to Toronto from a different group in the bank back in 2010, and Jasmine, who many of you may know, was lending in this space, and I was kind of looking at the type of companies and watching those companies grow over time based on getting the right support system around there. To me, that really de-risks lending to those companies. So reach out, don't hesitate to say, look, I'm not getting the response I want from my bank. Can you introduce me to somebody? RBC's group is the only one I know of that is formally structured at the smaller end. If I compare it across the boards, for the most part, you're going to be in small business banking with most of the banks until you hit a threshold of somewhere around $300,000 operating line. They're somewhere a little bit different. But come, that's our role. We'll help educate you on that and make sure you're pointed in the right direction. Have the conversations early.
Just one thing with regards to criteria. I think most lenders who are going to fund recurring revenue business models are open to funding burn that's related to sales expansion. So that's probably a critical thing to appreciate. That's where the risk profile, the risk to the capital, and therefore the cost of capital drops down low enough for it to work as debt as opposed to equity. And so, it doesn't have to be perfectly, break even before sales expansion spending, but substantially. So that's one important thing to keep in mind. The other is, just like with general senior lending ahead of us, if the bank is willing to do 2 or 3 times, we can bring in the other 3 times beneath them to give you the full 6x solution. And in terms of what drives the multiple from 3 to 6 for us, it's the margin, the customer lifetime value, the months to recover customer acquisition costs, the churn rates. Those key metrics really are the formula that drives the future cash flow that will pay us back and the risk to that future cash flow. So that's kind of our approach to SaaS.
Great.
Before we end, I would like to thank our sponsors. The 3 gold sponsors will come up here and speak shortly, and as well as RBC and Expresso Capital. So if I'd like to please invite Jeff Dennis from Fasken to say a few words and speak about Fasken.
Thank you. Hi, everybody. It's good to be on the panel with a banker, because usually it's the lawyer that's the bad guy. So I feel a little bit relieved to be with our banker friends. We're very pleased to sponsor this event. We're slowly building a partnership with BDC. In fact, I'm meeting with Jasmine tomorrow to talk about another event on valuations in January. We are a very different law firm. We're a very different law firm, and I'm a very different lawyer. We were called about a year ago the go-to law firm for startups and tech companies in Canada. And to a large extent, without being immodest, it's because of the role that I play at the firm. I'm the world's only entrepreneur in residence in a law firm. I'm a lawyer, but I spent over 25 years starting, building, running my own business, which I exited a number of years ago. And this is kind of my retirement gig. It's an opportunity for me to stay in the game, work with early stage companies on commercialization strategy and finance, and then be surrounded by one of Canada's largest and most international law firms. In my role, I sort of wear 2 hats. I continue to do the business advisory work that I did before joining the firm, focused again on commercialization and finance. But I also see myself as a bit of an intrapreneur, building a business like you guys inside this big institution, trying to create a practice which is relevant for early stage companies, which is not only affordable, which is often the big issue. People have very significant legal requirements before they have the ability to pay, and we recognize that. But be profitable to the law firm. It's got to make sense for both sides. So in my capacity as EIR, I've put together a team of young lawyers who have very diverse expertise, but because they're young, they've grown up with the technology. Some of them are developers in former lives. Some of them have really terrific industry expertise. We've created alternative fee arrangements, one of which I'll discuss in a second, which make us affordable. And lastly, brand building, just being involved in the community, sponsoring events like this, providing mentors and other resources in the community. I see a lot of familiar faces here, so I think to some extent I've done a pretty good job of getting out into the ecosystem. We have our startup program. In some of your packages there's a little brochure, but it's an indication that we are following the SaaS model. This is, I guess we'd have to call it LAS, Law Firm as a Service, but our startup program is actually a monthly recurring revenue model. It's about $150 per month, so $2,000 per year. Plus taxes and disbursements. You always have to put in the disclaimer, right? The lawyers can't help herself. But this is an indication of what you get. So we are working with startups and helping them with incorporation. We are moving their IP into the company. We are providing IP advice. 2 hours a month of consultation. Often it's with me, but it could be with any lawyer in the firm, depending on the subject matter and issue. And then access to events like this and other things that we do. But it's our way of getting in and talking to companies like you guys at a very early stage, making sure that you got your ducks in a row. Because one of the things that nobody talked about this morning was due diligence. You know, we heard about all the metrics around the business, which are very important. But you don't even get to talk about metrics if you don't own your IP, if your license agreements and terms of use and other contracts aren't there, if you don't have proper shareholder arrangements amongst the founders who are now being diluted, et cetera, et cetera, et cetera. So we see our job is to get you ready for that due diligence. Anyhow, I don't want to take too much time. It's been a long day already, but thank you. I'm glad to see such a great turnout, and if anybody wants to talk law, come see me.
Thank you, Jeff. I'd like now to invite Francois from E&Y.
Thank you, Denicia, and thank you for the opportunity to sponsor this great event. I see many familiar faces in this group today. EY, of course, this year is celebrating 150 years of doing business in Canada. Many will associate EY with large corp. We are the partner of choice of the Facebooks and the Googles and the Apples of the world. But for many of you, many were last night at the Entrepreneur of the Year Gala that EY is putting out every year for the last 22 years, and is hosting the same type of event in over 60 countries. So EY, among the big four firms, is certainly the company that is most known for supporting and encouraging and rewarding entrepreneurs. The one thing I would also like to say is that we value very much long-term relationships. So I would encourage you to start a conversation with myself, or I could also be a conduit to introduce you to some of our key partners on the advisory side, on the assurance side, also on the transaction side, whether your need is to get ready for an IPO or money raise, or doing a major transaction, a merger, or divesting of your business, and also perhaps put together a family fund to minimize any taxes that may be due at the time you divest of your business. So again, thank you for the opportunity. We'll be here. Brianne Stewart is a colleague of mine, and we'll be here for the next little while, and we'll be happy to answer any questions you may have. Thank you so much.
And our last sponsor, George from Bright Lane.
Thanks, Denicia. I'm George, and I'm a recovering lawyer as well. This program is very relevant to me, actually, the two components, because I'm a director of a SaaS, and have been for 4 years, called Mercatus Technologies. We serve the US grocery industry. And for 8 years, I was a Royal Banker, 5 lending to the IT and media industries. But that's not why I'm here today. I have the privilege of being president of Bright Lane, and it's a real honor to be a sponsor here today, so thank you for the opportunity. This is our coming out party. This is our coming out event. Bright Lane is a co-working center for up to 300 entrepreneurs located 50 yards east of here on the south side. We had a soft opening last week. Via Fora has made Bright Lane their home as Mercatus, and we expect to have our full opening on December 1st. We have an opportunity to host, become your home for many of you in this room. We have workspace for 1 to 6 people per company, anywhere from co-work desks to private offices, 11 meeting rooms, an event space that can accommodate this entire group of 100 or more. In fact, we do hope to host the next BDC event at Bright Lane. We're 30,000 square feet, and we were founded by G. Raymond Chang, the former chancellor of Ryerson University, whose commitment to lifelong learning extended to entrepreneurship. As co-founder of CI Financial, he wanted Bright Lane to become a place that entrepreneurs could achieve their success sooner by networking with others and getting some very interesting entrepreneurial lessons learned from those who've succeeded and failed in the past. So we really encourage you to check us out on the website, breitling.ca. And frankly, after the event, if you want to walk 50 yards south, or east and south on the way to the subway, come up to the 3rd floor. It's still a construction site, but we've already got about 35 people on the floor, and we'll give you a tour. Thank you very much. 545 King West, 3rd floor.
Thank you so much. All right, so we are getting to the end of the day. Again, I would like to thank our sponsors and our speakers. Without them, this event wouldn't have been possible. And thank you for coming out today. We do have the room available till 3, so feel free to stick around and network. I just wanted to highlight a few things. Before we leave here today, by 3 p.m., I will send you a short survey. If you could take the time, it should take you about 5 minutes to fill it out. It'd be really important to us. We are looking to have follow-up workshops to sort of drill deeper into the operational side with regards to SaaS companies, marketing and sales, maybe get a roundtable of CEOs and share best practice and so on. So ideas like that of what you would like to see in terms of workshops would be great to provide feedback. And also, I can't even read my notes. Oh yeah. Lastly, we are recording the whole event. So if you didn't get a chance to take down a key idea or whatnot, we will make that available to you. So I'm not sure how long they'll take to edit it and put it together, but as soon as I have that available, I will email it out to the guests today, and as well as the presentation slides from Wilson. So that's it. So thank you again for joining us today, and looking forward to connect with you if I haven't met you already. Thanks.